Hello and welcome to Stocktalk, Self-Trade's regular investment programme. In this edition we'll be discussing low-risk investing and asking how the more risk-averse amongst us can plan their portfolios. And coming up, I'll be speaking to an industry expert, asking the public about their own attitudes to risk, and handing over to the wise monkeys to answer your investment questions. Having a clear attitude to risk is key to successful investment. There has to be enough risk to deliver your desired returns, but not so much as you have trouble sleeping at night. For those building low-risk portfolios, there are opportunities to achieve growth while preserving capital. Cash deposits offer the lowest level of risk, but also the lowest returns. For some, bank deposits will represent the most appropriate home for their savings, but for others, who are prepared to accept a little more risk, much better returns are available elsewhere. Diversification is key. Don't keep all your eggs in one basket. So in building a portfolio, some element could have more risk than others. In a low-risk list, preserving capital in all but a small proportion will be important. Slightly more adventurous than deposit accounts are cash funds. That's unit trusts and OICs which pool investors' cash and invest in the best cash products available. Fixed interest is perhaps the next level. That's government or the best quality corporate debt, offering good returns and, if held to redemption, reliable returns. Some investors might prefer to access these through collectives or trackers. It is the stock markets which have traditionally offered the best returns to investors over the longer term. But stock markets come with risk. Nonetheless, shares can have a place in even low-risk portfolios, and capital-protected structured products could be a useful way of managing the risk while still participating in stock market growth. Accepting more risk, there are also a range of cautious managed funds where fund managers select the best low-risk multi-asset returns by mixing bonds, equities, commodities and the like. I'm here with Stephen Andrew of M&G's multi-asset team. Stephen, can I start by asking, what is your own approach to investment?
Sure. Well, as you say, I'm part of the multi-asset team, and on our team, as the name suggests, we adopt an asset allocation in a multi-asset framework. And what we think we're good at is figuring out where we are and how we got here, and the range of outcomes that are probable from where we're sitting for both markets and for the fundamentals, so for the drivers of markets going forward. So then we take a look at where the market currently thinks those things are going and where the market's priced for the individual assets and how they're moving together. That basically drives our asset allocation decision.
And if you were a risk-averse investor, how might you best structure your investments?
Well, I think it's important that, I guess, we clarify what we mean by risk-averse. If you're totally risk-averse in an investment context, you should probably just buy gold because it's the only consistent store of value for thousands of years. It's not going to give you a return, it's not going to give you an income. So if investors are risk-averse while being interested in those things too, diversification is the key, frankly.
Okay, so taking that forward, how might a risk-averse investor mix different asset classes?
Having an exposure to equities, I think, is a prerequisite in terms of getting some return, but balancing that with something that isn't likely to drop by 30% for some unknown reason, or because simply the bear market happens not to be over yet. So, from that point of view, the cautious investor should try and maintain an exposure to solidly funded companies. So we're talking, I guess, infrastructure, the type of stuff that, frankly, governments spend money on, both West and East. So it's infrastructure, it's hard assets, it's commodities, balancing that with some more elements which are seen as safe havens, such as government bonds. And there are French Treasury inflation protection securities, there are US index-linked and there are UK index-linked, good, deep, solid markets that you can protect your capital in a rising inflation environment.
You're also an economist here at M&G. Which economic indicators should investors watch out for?
We need to discern the nature of this cycle in a very different way to that which we've looked at the post-war period. Now, there are some indicators that have been very good at telling us when the bottom has been reached in that post-war period. One of them is a US indicator, which has been a very good barometer of global demand growth, and that's the ISM, the Institute for Supply Management Index. That's a very useful indicator. It's already bottomed, and it's had a couple of monthly rises, but we shouldn't get carried away. It's very early stages. Another is the Baltic Freight Index, which measures the cost of shipping stuff from one end of the world to the other end of the world. That's bottomed as well, albeit at a very low level. Another is consumer confidence and consumer spending. But, and the but is a pretty hefty one, while some of these indicators may well reach a bottom and start to look like they're recovering, we really do need to be careful in terms of our interpretation of the durability of that recovery. And there the labour market holds the key. So in that sense, indicators that the corporate sector has shed enough staff. So looking at vacancies, looking at hiring intentions, and the standard employment numbers should give us some clue about the stickability of this recovery.
On that point, and finally, how does an investor know when the cycle has hit rock bottom?
He doesn't. He certainly doesn't know beforehand. He only knows after it's already occurred.
Stephen Andrew, thank you very much.
Thank you.
We spread it out. You invest in emerging markets, you invest in large cap, small cap, fixed income, try and mix it around, I guess.
I make sure the amount I'm investing I can afford to lose in the worst case scenario, so I don't think if I make a 50% loss, I think if I lose the whole lot, it won't be too big a hit.
Well, I try to spread my funds because I want to manage the risk like anyone would want to.
To be honest, no, I don't worry any much more now. I'm a bit concerned about my pension and the way that's being managed now, because that's out of my control to some extent. But no, I'm not any more worried than what I am normally.
I mean, I've been here a couple of times before, right? It swings and roundabouts. This is not the first time, it's not the last time. We'll be in this situation again, no doubt, in the future. And as the cycle goes down, the cycle goes up. You just have to try and look for some signs that the momentum's turning around and there's some opportunity to be had.
Wise Monkeys is done filming for today, but Dave and Stephen have decided to stay behind to give us their interesting insights on the subject of low-risk investing. Hello, gentlemen. Is the stock market the right place for a low-risk investor?
I would say that shares do have a role to play in a low-risk portfolio, and you probably orientate it towards big blue-chip companies that pay out a decent dividend that you've heard of. I think they have some value. I think that they would be a smaller part compared to government bonds and gilts that I think are a much safer bet.
And do you think that the market's a good place for a low-risk investor?
Yeah, I think David's broadly right. I think that equities shouldn't be the bulk of a portfolio if you're investing for low risk. It's clearly a higher risk asset class. But actually it doesn't mean that the stock markets don't have a place in diversified low-risk portfolios, and particularly if you're using sort of multi-asset funds or collectives, where you buy into the diversification and you can diversify into all sorts of other asset classes which are much lower risk, then it can mean that you can have a proportion of the portfolio which has exposure to the markets and to equities.
Very interesting. Thank you very much for your time.
Well, that's it for this edition of Stock Talk. If you have any comments or suggestions, email me at research@selftrade.co.uk. Thank you for watching.